get ready before life happens. The podcast helping you navigate life's what ifs.
Welcome to the Get Ready Money podcast, changing the way we think about money. I'm your host, Tony Stewart. Today, I'm joined by Joseph Pach, Chief Investment Officer with Corcovado Investment Advisors and author of The Young Investor's Edge, How to Think About Risk, Growth, and Money. Joe, welcome to the podcast. Great to have you here today.
Hey, thanks, Tony. It's great to be on, and thanks for having me. I really appreciate what you're doing with the Get Ready movement.
Fantastic. Yeah, no, and I appreciate that. And, excited for this conversation. As we were talking pre-show, is I don't think we talk enough about risk and the importance, because through our lives, we're always assessing risk. So to start off, tell us a little bit about yourself. What is your origin story and how did it lead to you writing The Young Investor's Edge?
Um, it's actually, I did change the title recently to Building the Investor's Edge because I didn't want to alienate some of my readers. So uh, it was at a last minute, it was a change. But I got my start in 1993 on the options floor of the Pacific Stock Exchange. And I started initially as a runner and eventually became a floor trader. And this was really during the height of the dot-com boom. And I was down there for 6 years, and I left in 1999 to join a hedge fund. And I was there for the collapse of the dot-com phenomenon. And then in 2001, I moved on to Mellon Capital Management, which was a major institutional investment advisor in San Francisco. I spent 20 years there with a team managing global portfolios for pensions and endowments. In 2021, I started Corcovado Investment Advisors. It was a good time to take my whole entire experience to serve individuals and families, especially during major transitions such as divorces, inheritances, and concentrated stock positions, where my expertise could really serve best. And it's been a really rewarding journey, and I love what I do.
Well, that's fantastic. Yeah, and I'm just thinking back I first started working in a San Francisco financial district, and at some of the delis and stuff, you'd run into the runners and everything, and it's like, wow, that
It
seems
was
a little
crazy.
stressful.
Yeah, it was crazy. It was really at that time, it was kind of the epicenter for all that tech stuff. And so it was really, hindsight looking back, it was it was a fun but volatile time.
Definitely, definitely. So, let's, get into this a little bit is what first led you to recognize the disconnect between traditional financial education and real world decision making? Was there, a spark or a moment that made you say, we need a better way to think about this?
Yeah, there was definitely a moment. And you know the saying from Mike Tyson that everybody has a plan until they get punched in the mouth. Well, there's a moment in time that it became very clear that what's learned in school, so in financial education, we learn about models, we learn about processes, we learn about plans, and all of this is incredibly important. When you are actually in the thick of it, in the markets, that's when you get punched in the mouth. And my moment that I really kind of came to realization of that was in 1997 when I was still a floor trader. The floor traders, particularly options floor traders, were allowed enormous leverage. And this is good. It's absolutely necessary. We know how to manage risk and everything like that. But with a couple 100,000 in our accounts, we can manage upwards 10, 15 million in exposure. So the swings can get quite large. And so in 1997, I kind of had a moment where I was getting very frustrated. And my P&L swings, my profit and loss swings were were really kind of beyond my comfort zone. And I really was expecting the gains because they were handsome and I felt well rewarded. But the losses I took as personal failures. And so there was just this moment where I had to kind of detach myself and realize that it wasn't the market itself that was the problem, but it was my outlook and my expectations of it. And from then on, I realized that I could have all the tools, but my attitude towards the market needed to change for it to all work. And that's when I started looking at the market and life as raw energy and something kind of like a wave that you could surf or should surf, something that needs to be respected for its power, but it's chaotic. And so we can really it was at that point where I really realized I can control my exposure to this, and I can harness it in a way that works out for me.
Yeah, well, that's interesting. Let's go back just for a second and talk about what is leverage, because I'm sure a lot of people out there have heard the term leverage, but they don't fully understand what is leverage. So, just in the way you used it, is how does leverage work, and how does that apply for people?
Leverage is a an amplifier, and leverage can be used in an active sense. You can use it to, I mean, let's just take an example of a house, for example. If you buy, say, $1 million house and you put 20% down, well, you're basically, and if that, let's just say that 20% is your net worth, you put 200,000 down, you're actually taking massive leverage to control $1 million investment with 200,000 in capital. So historically, leverage has always been used for hedging purposes. Leverage is used in the futures markets and in other markets to hedge risk. But a lot of people can use it to actually amplify risk. There's nothing wrong with that, but one needs to manage the downside. But leverage is basically the ability to control more capital than what you actually have on hand.
I like that. Is I think that's important for people to understand, is that leverage works in a lot of different ways. And if we think to physics, and we know that using a fulcrum allows you to accomplish more. So I think for people to understand that, and let's talk about risk for a second. Is how would you define risk?
Oh gosh, that's a really good question. Because there's so many different kinds of risk is what you stand to lose. That's really what it comes down to. Or what whatever you're referring to in general, it could be the government, it could be, but risk is basically what we're talking about is downside risk. And in statistics, we would call it left tail. Uh, because if you're taking leverage, say for example, and you're making money, you're profitable, you're not really thinking so much about you're not in a bad mood, but risk is really it's covering your butt, it's why you buy insurance. It's about being able to sleep at night. So it would be your downside, your what you're exposed to on the downside.
Yeah, well, I love that. And I think that is the perfect definition of risk, is because it really is that simple at the end of the day. Is, yeah, risk can get super complex, as you mentioned. But when we talk about insurance, is, that's what really any type of insurance is protecting against a potential negative outcome. When we think
Yeah.
of auto insurance or homeowners insurance, we know what the risk is. And that's what we're constantly assessing as humans. I mean, if we think about it, when we get into the car, there's a risk of crashing. So we put on our seatbelt. And that's a protection against a risk. Now, that's, of course, not going to protect you if you get into a really violent accident. but it is something that you're doing to think about risk. So, that's a great description.
So, and I'm going to segue a little bit, and I love where we're going with this. The one of the reasons why I wrote "Building the Investor's Edge," and I'm happy you actually mentioned the earlier title. That's what I had sent you. That it was the impetus behind writing this book was really to be able to talk with my kids about what I do in as much of a non-mathematical way. And math is a wonderful thing, but when you learned it in school, it's kind of like learning how a car is made without really understanding the utility function of it. You don't know where a car can take you. So what I really wanted to do was kind of that was why I needed to explain exactly kind of why I wrote that. But the other reason is, as you're talking about risk in life as well, we define risk and reward differently sometimes. And reward can be, particularly to people of certain age groups, reward can be really false. It could be social acceptance. And when you're looking at, you talk about getting into a car, suppose you're a high school student and you're being persuaded to go to a party with a bunch of really popular people that you really want to like get in with, and the driver there is drunk. Well, you're thinking, I want to be popular, I want to fit in, I want all this kind of stuff. And it's short distance and so forth. But what you're risking could be catastrophic. And so, uh, these kinds of assignments of really the risk is very real. The reward, it's kind of meaningless. And it's very important that people kind of really define very clearly what the reward truly is.
Yeah, I love that because I think that's something that we miss in our financial lives is when we're talking about certain products, is like, let's take crypto, for example,
Mm,
is, you know, is there a reward? Yes. Is there a risk? Definitely. Do you understand it? And I think that's the other part of it is, can you define the risk and reward is? Because with crypto, I can't really define what crypto is. I definitely can't outline the risks and rewards, but to me, and I know the purpose of this conversation is not really to talk about crypto, but I think it's also one of those things is that you have to be able to define, like you said, the risk and reward is, something in a scenario you mentioned is the driver is drunk. We know that risk and we know that that's a high risk. So we can pretty much clearly define it. And as you said, the reward is, what is the reward at the end of the day? Is anybody even going to remember that you got in the car or didn't get in the car?
ex-
It's
exactly.
uh, uh, oh,
With regards to crypto, that I think that there are a lot of risks out there. It's way beyond what I think I should be talking about today. But the risks, I think crypto is very that's a completely different topic. I could come on later and we could talk about that. But
yeah.
the risks are many, you know.
Yeah, and yeah, just to, we do want to leave crypto alone. But I think overall the thing is can you define it? Do you understand it?
Exactly.
And I think that's the thing for me is when it comes to investments in the financial services world overall, is that we have all these products and services and people in the industry. I know this happens on the life insurance side. They don't understand some of these complex life insurance products, but yet they're recommending them to people. We have consumers who buy them. They don't understand the products. They don't it makes it really complex. And then we have consumers on the other side who don't understand what they're buying. But anyway, we could go down that whole road. So sorry, taking us down a different road.
Yeah. But one thing kind of bringing us back is the important thing about risk, and one thing that I really want to structure is that when it comes to, say, financial markets and life in general, we tend to, I think it's human nature to become somewhat complacent and maybe expectant of a scenario to happen. In the financial markets, as we say, they go up, the equity markets tend to go up on the escalator, but they go down on the elevator. And leverage can have a lot to do with that, but that's kind of beside the point. If a bull market, which would be a market that is upward trending, persists over time, it takes on certain characteristics and certain kind of regular movements. That would be considered the volatility. Sometimes, you would kind of come to expect the movements of the market and you would expect them to persist. But then there's a catalyst, and that can really upset the emotional balance of things to the point that it can create lots of irrational decisions. And these are the things that, it's like it's recognizing your risk, but it's also the pattern of the risk. And when you find that, let's just say on average, you've been making 1.5% per month for the past year or so on a very, very sort of regular kind of pattern. And then all of a sudden you're down 20% over 3 weeks. That's a huge shock. And a lot of people don't really know what to do with that. And a lot of people may completely sell out of their positions. A lot of people may hold on. You don't really, you have to come to expect some of these things. Like in 1929, between 1929 and 1932, the market lost close to 90% of its value. It didn't take, no, it took another 20 plus years to recover. So these are some of the things that this is why it's also very important to me to get this message across that, there's this asymmetric structure that can happen in the market. It hasn't happened for a long time, but the market still takes these things on. I mean, you saw it in 87, even in the dot-com bust, the NASDAQ itself lost, I think, close to 90%. So these things can really happen and they can just pull the rug under people's, feet.
Definitely. And so, it's always smart to have a plan for protecting against these risks because, like you said, risks happen. And so you have to uh, protect for them because you never know what's going to happen.
Yeah.
So, let's get back to your book a little bit. One of the things is your book emphasizes developing practical frameworks over memorizing facts. What's one approach or system from your experience that empowers people facing uncertainty or major transitions that they can apply?
Well, it's a two-step process, and I can outline it very quickly. When I was 18, I was sitting in the waiting room of an oral surgeon waiting to get my wisdom teeth pulled out.
Oh
And
boy.
and I hadn't been put under general anesthesia for I hadn't been under anesthesia at all. So, I wasn't like freaking out, but I was very uncomfortable and nervous about the situation. So I thought, well, I have a choice here. I can walk out and I can, I can walk away from this. And it might feel good from a short-term perspective, but from a long-term perspective, it's probably disastrous. Or I can choose to stay and maybe have a recovery period of a couple days, but overall, it's probably what should happen. So that was the first step that I needed to think about very clearly about what I can do to improve this situation. What control do I have? So I made that decision. It's going to happen. Then the second choice really is now that something is happening, now that I've accepted this, how do I carry myself through it? Am I going to, I have a choice now to either still remain emotionally agitated, or I can be calm. And so that answer was very clear to me. And these kinds of that it's really kind of a two-step process that can carry anyone through any situation in life and death. It's you try to ask, what can I do to improve the situation? Once you're past that, and oftentimes, like a medical prognosis or something like that, you're not even involved in that part of the equation. It's how do I carry myself through this? And we have full control over that. So that's really, in short, how I do it.
Definitely. Well, no, I love that. And I think that gets back to the analogy of the market is, again, we're not giving out any advice or anything like that. But,
Right.
if the markets go down, as you mentioned, they're more of a big drop than the slow climb. And so it's like, how do you react to that? But part of that, in my mind, is being prepared for the fact that that is almost inevitable,
Hmm.
that there are going to be those sharp drops. And, the term for people not familiar is a correction,
Yes.
which, maybe is not the best term because it sounds like there was something wrong in the first place, which may be the case. But, uh, you know, I think that people just need to be prepared is like things are going to happen. The market is not going to act as you hope. I mean, we could get into Benjamin Graham and Mr. Market and all those things, what's it an irrational walk? Uh,
Oh,
random walk down Wall
Burton Malkiel.
Street.
Yeah. Yeah. A
Yeah,
random
a
walk
random
down Wall
walk
Street.
down Wall Street,
Yeah.
like trying to see which way it's going to go is like, you're not going to guess it.
Yeah.
Uh, so, anyway, so, the next thing is, that you talk about opportunity costs, leverage, and risk asymmetry. How can someone begin to apply those concepts without getting bogged down by complexity or math? Because I think this part of when we think about these things, leverage and risk, it's like, oh my gosh, I have no idea what these things are. So how can I even begin to apply them when you think that these are so complicated?
Well, I like to think about them in a hierarchical structure. It's maybe even sequential. And that way, like an opportunity cost is really about how one might allocate their time, what you're giving up to gain. And I think that that's kind of at the top of the structure. It's even like the last sentence in my book was, nobody on their deathbed has ever said, I wish I spent more time at work. And so I always look at that as sort of how am I going to live my life? I think like in terms of what you're going to give up to gain something. From there, risk asymmetry is really looking at what you stand to gain versus what you stand to lose. And what's my upside? What's my downside? And in any kind of an investment scheme, you want to minimize your downside and maximize your upside, potential at least. And sometimes, this can be dynamic or sometimes it can be set beforehand. As we talk about, corrections and things like that. Well, with the expectation that the unexpected can happen, that's when we really need to think about position sizing, allocation, things like that. So if a worst case scenario happens, we're probably going to be okay. Um, Once you can establish that you have a good risk reward function, then you can apply leverage. Because as I've mentioned before, leverage is really an amplifier. And if you are in a situation where you're offered a coin flip with a fair balanced coin, 50-50 odds, and the payout is say $1 for heads and 0 for tails, your expected value on that is basically zero point 0.5 times 1 plus zero point 0.5 times 0. Your expected value, you sum that together, it's zero point 0.5. So you would, in that kind of a situation, if you paid 50 cents to make that kind of a bet over a long period of time, you're going to break even. If you're ever in a scenario where you would be paying anything less than 50 cents, call it 40 cents, 30 cents, then over time, you have an edge. And when you have an edge that seems pretty certain, then it's safe to take leverage. You you want to do that as much as you possibly can. But when you go into a casino, for example, in general, the house is always going to have the edge. You're going to be paying more than 50 cents. And in many cases in life, you're going to be paying more than what you stand um, you're going to be paying out more than you stand to gain. So it's really kind of a three-step process when, getting back to opportunity cost, risk asymmetry, and leverage. You never want to take leverage when you stand to lose more than you stand to gain.
Well, and I think that, again, that translates to everything in life is that we're constantly making those decisions.
Yeah,
Is, you know, do we get an edge? It's like thinking about it this way is like you have two gas stations. One has cheaper gas is like, well, why not go to the gas station that has cheaper gas unless for some reason there's a problem with their gasoline or with that station or something like that is where it's an inferior gasoline. And okay, this may not be the best analogy, but it's kind of like we are making that risk reward assessment, maybe between two restaurants. If one is running a special where you get a two for one entree and everything else is equal, you're going to go where you get the better leverage for your dollar, unless you really
exactly.
want to go to other restaurant. Um,
That's a good example. It's true. And we're always going to gravitate towards that. Where do we get the best deal? There's some qualitative and quantitative factors involved, but overall, that's how our mind works.
Definitely,
It,
yeah. With everything else being equal,
yeah,
we're going to choose the restaurant that has the better deal.
yeah,
Um, and why
yeah,
not? So,
yeah. That's a really good that is a good example.
so, yeah. So I think this stuff is super helpful. So, as we start to wrap up, I have what's called the Get Ready Hot Take Trio.
Hmm.
These are three questions that I ask all of my guests. The first one is, what money myth are you trying to break?
I think, really for this situation that finance is some kind of a secret club and you need credentials or pedigree. And I think that a lot of people are their own worst enemies. And you're doing a really good job at breaking that, because I think people get very intimidated by the numbers and by the concepts. And as an example on the trading floor, I stood next to people who were chess masters, who were incredible bridge players, PhDs, but I also stood next to people that never finished high school, and they were some of the sharpest traders I'd ever met. There's, so I think that people need to kind of take down those barriers that they set for themselves. So that's the real myth that I'm trying to break. I'm trying to, getting back to my kids, I try to tell them to use the words of Robert Ringer to be a pain in the ask and to demand clarification. And I think to the listeners out there, it's the confidence in their potential that matters, not what they've done, but in their potential. And so, pay no mind to intimidation or other distractions. Your goal is to understand, and keep really asking until you understand. And at the end of the day, that's really all that matters. So I think the myth of you need some special anointment to understand it is BS. You know,
Yeah,
Gambate, as we say in Japanese. Yeah.
well, and I'm with you 100%. And that is definitely a theme that runs through the show with all the different guests, is that for people who've watched and listened to the show for a while, you've heard from a whole variety of guests that come on the show. And that is a theme, is that everyone can take on money. Is, yeah, some people come from a spot where it can be more challenging, but it is accessible. Everybody learns it or can learn it at some point. Um, so yeah, I love that. And I think the other thing you said that's super important to emphasize is that it's all about asking questions. If you don't ask the right questions, you're not going to get the right answers. So you have to ask questions, and you have to be comfortable. Spend as much time with your financial products as you do searching for a new television or a
Yeah.
new car. Yeah,
Yep. Yeah, I
get
agree.
get that research. So, Joe, let's get out the time machine for a minute. What advice would you give your younger self, going back in time, knowing what you know now about money and risk?
I would have to say that I'd tell my younger self, you'll never have all the details in advance. Now, I don't know how much this applies to all the listeners, but I think that I have always waited for perfect clarity, and I think that that's a trap. And I don't think that, sometimes we can all go into this analysis paralysis, and really, each decision is just a step. And I would say that have confidence in your ability and understand that life unfolds in permutations. Each moment is a choice to continue or to abandon, but either way you learn. And so perfect knowledge ahead of the fact is impossible. So you have to wade in the water one step at a time.
Definitely. Well, I love that advice. And the other thing is, things are constantly changing. So, if you're waiting for that perfect moment where you know everything, it's not going to happen, because things will have changed by the time you get that last piece of information.
Yeah.
So, to wrap up, what is your number one tip for changing how we think about money?
Ooh. Um, I think my number one tip might be a little bit different. It's to shrink the emotional response. And as people go through transitions and so forth, I think that people can rush to bad decisions, whether it's a divorce or even a windfall, a career change. I think people need to pause, take inventory, and separate what's urgent from what can wait. Even in a separate matter altogether. It's like the unexpected. My mom got a broken neck 5 days ago, and that was a rather unexpected situation. And just like in the financial markets and so forth, we all have these situations that we're not ready for. And I think the really important thing to do is to shrink the emotional response and think logically about this. So the reason why I bring up this personal situation is that now I'm dealing with my family, and I'm dealing with really listening to all the players involved and seeing where I can best add value. And I'm thinking the whole scenario, I need to like really focus on shrinking the emotional response. She's going to be okay, but we can't have too many cooks in the kitchen. We need to really think, um, how do I, and I'm thinking to myself, how do I really clean up this whole situation? So, say my father can make the best choices. How do I clear pathways for him? How do I make things less complicated? How do I um, you know, create a calm environment? And I just use that analogy because this is something in financial that we're faced a lot. Not on an everyday basis. But when things go chaotic, we need to think about calming the emotional response.
I love that is when things go chaotic, we need to concentrate on a calm response. And, I used to do wilderness first response, and I helped teach with a friend of mine, and her company was Foster Calm. And that was the whole thing is that when there's an emergency situation and people are, having emotions and things are going on, and there's stimulus and things to deal with, is that if you're
Yeah.
not calm, you're just going to add to the chaos. And that, that's the first step you can do is to take a deep breath and think about what you can do, like you said, is to make things work smoothly and start to repair things.
Absolutely. And that's how I deal with my clients as well. People are coming in with completely, different scenarios, and I think the first thing to do is to try to simplify their lives.
Yeah, simplification. And, so for newer financial planners or insurance agents who are listening to this podcast, other professional advisors, is that, yeah, that is super important is, help your clients become and simplify, what you're recommending to them is, yeah, a 200-page financial plan is helpful and something that they need to do, but you have to take that financial plan one step at a time. Otherwise, you're going to continuously have your clients go, "Oh yeah, well, I didn't get around to any of it." I know we got a punch list from our estate planning attorney after we finished the estate plan of all the things that I need to do afterwards. And it's tiring. I'm a professional and I know that those things need to be done. And I understand what each of them is and how to do it. And it's still like, it's overwhelming because
Oh
it's
yeah.
not simple. So. Good takeaway. So, Joe, where can people learn more about you and pick up a copy of Building the Investor's Edge?
Well, that's on Amazon, and I would advocate Amazon. It's been a great experience publishing through that, and everybody's got a story. So if anyone has any kind of an inkling, and as well, Tony, it's like, if everyone's got a story to tell, and so I would encourage people to actually be authors if they want. So Amazon is on Amazon. I'm also on Substack. I've got a blog called the Silver Lining, and that's Joseph Patch. That's just my name, one word. .substack.com. I'm on Twitter at Joseph Patch 90318. My website is Corcovia. That's www.corcovia.com. I got a QR code in the window too. And my firm is Corcovado Investment Advisors. And I'm an RIA. I started out as a commodity trading advisor as well, but I'm an RIA now, and I'm specializing in transitions and so forth, life transitions.
Fantastic. And for everybody watching and listening, as always, there will be links to all of these things that Joe mentioned in the show notes. So if you do have access to, uh, the website, go ahead, check out the show notes, and you'll find links to all of these things. So, Joe, thanks for joining us today on the Get Ready Money podcast.
Thanks so much, Tony. I really appreciate it, and look forward to working with you in the future.
Yeah, definitely. And thank you, everyone, as always, for tuning into this episode of the Get Ready Money podcast. If you learned something today, please be sure to like and subscribe to the Get Ready Money podcast. If you want to learn more about my work, you can and join the Get Ready movement. You can go to my website at tonystewart.com, receive my newsletter, podcast updates, and have access to a whole bunch of free resources. Until next time. Let's change the way we think about money.